Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, February 28th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, is President Trump purposefully crowding out liquidity to kitchen sink the economy and asset markets? And is the U.S. economy heading into another technical recession? My answers are, in the interest of time, we'll spare you our usual prose and just display the headers of the charts and tables, of the supporting charts and tables on slide 51 through 77. We'll unpack the analysis for our clients in tomorrow's Around the Horn presentation. So let me just go down the list and read the headers from these the charts and tables. So the first one is, reminder, a global debt refinancing air pocket is the #1 market risk for 2025. Why? Because the global debt refinancing air pockets cause deep corrections and crashes in risk assets amid global dollar scarcity. The anticipation and implementation of President Trump's tariff policy has contributed to global dollar scarcity and an all-time high in the value of the U.S. dollar on a broad trade-weighted basis. Tariffs contribute to global dollar scarcity in two ways. Number one, by diverting would-be household savings, corporate profits, and FX reserves to the U.S. Treasury. And number two, offsetting currency devaluations. The 2018-19 U.S.-China trade war resulted in a 13% decline in the Chinese yuan, a 13% sympathy devaluation of major currencies versus the U.S. dollar, and a max drawdown of 20% in the S&P 500. Reminder, the U.S. dollar and currency volatility are countercyclical leading indicators of global liquidity. U.S. dollar strength is a headwind to global liquidity because it reduces both the supply and demand of dollar-denominated debt. Reminder, the U.S.'s net international investment deficit doubled to $20 trillion in the 5 years through December of 2023. Foreign investors will liquidate U.S. assets and other stores of value if a too strong U.S. dollar threatens their ability to service debt. The U.S. Treasury will crowd out the global private sector and perpetuate a global debt refinancing air pocket if the Fed does not supply liquidity on a proactive basis. If the 42 secular inflation model is correct, then the Fed will have a difficult choice to make in 2025. Incrementally revise its inflation target higher and satisfy historically robust demand for liquidity, or commit to its stated 2% target and respond to a global debt refinancing air pocket after the fact. One factor complicating the Fed's decision-making process is the debt limit. As such, we believe the Fed will likely end the Treasury portion of balance sheet runoff soon as a result of this and the slowdown in nominal growth. The decline in the TGA is in line with our expectations, but it is being partially offset by a rise in the RRP. The rise in the RRP is likely month-end window dressing and unlikely to be sustained amid robust spreads for private repo and rising expectations of rate cuts. And finally, another temporary factor draining liquidity is the largest month-end coupon auction settlement since May. How markets trade next week will go a long way towards determining if this is a correction or a crash. And then wrapping up, with respect to the U.S. economy potentially heading into a technical recession, the January PCE report was supportive of our forecast of slowing U.S. growth that surprises expectations to the downside. Structurally elevated policy uncertainty is contributing to the slowdown in consumer spending, alongside sharp pullbacks in consumer confidence among upper-income households and bullish stock market expectations. The accelerations in real and nominal disposable personal income imply the combination of bad policy certainty and good policy uncertainty slowed consumption via the confidence channel. The January PCE report was supportive of our forecast for a continued moderation in the U.S. labor market. Persistent leading indicators of the business cycle still signal limited risk of a recession over the medium term. That said, DOGE risks turning a moderation in the labor market into an outright deterioration if the nascent fiscal contraction deepens. The nascent fiscal contraction can and likely will get a lot worse over the medium term. The January PCE report was supportive of our forecast for a Q1 bottom in core PC inflation. Now, note everything I just said, every single one of these bullets that you see here on the slide, every single one of these bullets that you see here on slide 5 as well, is supported by institutional grade risk management analysis or an econometric analysis. There's a chart and or table, supporting each one of those conclusions. This is high-end institutional grade stuff. We're very proud to market this to the general public at the rates with which we market them to the general public. I believe our leadoff morning note, I haven't checked in a while, but I think it's $55 a month or even less than that if you subscribe on a quarterly basis. This is the kind of research that costs tens of thousands of dollars per quarter on global Wall Street. And the reason we're democratizing it at that price point is because I want people who grew up like me without a dime to their name to be able to access the top flight research on global Wall Street. We want them to take advantage of the same quality of research and the same quality of signals that the best hedge funds in the world are tapping into, the best asset managers in the world, pension funds, insurance funds, sovereign wealth funds, family offices, investment advisors, you name it. We have all of those types of clients here at 42 Macro because they understand the value of what it is that we're producing. And the reason we sell it at such low price points is, again, so people who grew up like me, again, every dollar that's in my brokerage account, I had to earn. Every penny in my brokerage account, I had to earn. There was no rich dad or rich uncle that could come, give me a Wall Street internship or put a bunch of money in my trading account so I can learn how to trade the stock market when I was in high school. I didn't have any of that. You know what I had? When I was at Yale, I couldn't afford to fly back home to Seattle throughout that 4 years. And so I was obviously stayed on campus throughout every summer. And freshman year, the summer after freshman year, there was about a month between when my job on the Yale golf course started and the end of school. So there's basically, I no longer had financial aid to support me. And so I basically had to, make ends meet to eat. I did a psych experiment for $10, $15, $20 every single day for a month just so I could have money to eat. And again, this is the kind of ethos that I'm building, that our team here at 42 Macro is building this company on. That's why you see some of the best research on Wall Street delivered to your inboxes at such low price points, because I want to make sure that the impact that I have on the world before I get out of here is extremely positive. And I'm really grateful that God has blessed me with the ability to create such high-end institutional thought leadership with our research. So transition to our 42 Macro dashboard before I wrap up. As always, I'll wrap up with a question from our community. This one's regarding Bitcoin price action. It says, hello, Darius. Would you kindly comment on the recent Bitcoin price action? What is your expectation in the short to medium term? So I'll tell you what my fundamental expectation is, but I'll tell you that has no bearing on how you should be positioned in asset markets. How you should be positioned in asset markets is a function of our systematic KISS portfolio construction process if you're a retail investor, or our discretionary risk management overlay if you're a institutional investor or a sophisticated retail trader. You can go check out our website to get more information about that. But on the fundamental side, we expect the transitory sort of issues with respect to liquidity that's causing the RRP to rise, and that's draining liquidity from the system and offsetting the TJ spin down that we've been forecasting for 6-7 months. That stuff is likely to end starting today. When we get into March, things will get better. Now, how much better they get, it really be a function of, okay, can we start to get the dollar back down and support the anticipated increase in global liquidity that our model is still forecasting? And we'll, if we start to see some of these, U.S. repo market dynamics get better at the margins, then we will actually see an uptrend in U.S. liquidity that's being perpetuated by the decline in the TGA. So I'm expecting things to bottom out roughly here, at least in Bitcoin price terms, and start to rally higher. But that's my fundamental expectation. That fundamental expectation could very much be proven wrong if President Trump is, sort of moving ahead with a strategy that we authored back in the fall of 2024, which is, hey, they should probably, if they're smart, they would kitchen sink the economy and asset markets at the beginning of his term, blame President Biden for all the reasons why he had to do that, and then implement his supply side economics policies to sort of come and save the day. Now, whether or not that is what his voting base wants, the MAGA community actually wants in terms of supply side economic solutions, I'm not so sure that is the way to go. But we'll see. That may have some political ramifications in the future. But I think we as investors need to be aware of something I've been talking about ad nauseum daily almost, is the width of the distribution of probable economic and policy outcomes is about as wide as I've ever seen in my career. And sadly, unfortunately, the widening part of that is generally skewed to the negative side of things. So I say all that with the requisite humility to understand that, hey, if the president of the United States wants to rip up the script and kitchen sink the economy and asset markets, he very well has a lot of levers, including tariffs, announcing incremental tariffs on China last night, including tariffs to do so. So I wouldn't want to fight that as an investor, with my fundamental expectations that liquidity on the U.S. and global side will improve over the medium term. That may not be the case. And so at the end of the day, I'm just going to do what I've been doing for years. That's caused me and our clients to make a tremendous amount of money over the last couple of years. Is just continue to respect our KISS and Dr. Mo signals as they evolve. So with that, I'll wrap it up. Darius Dell here presenting our macro minute for Friday, February 28th, 2025. Everyone have a wonderful weekend. Catch you back here on Monday. Cheers.